Disclaimer up front, this isn't financial advice. This is educational content and a few trade ideas for the week of July 14th. Trade at your own risk, manage your own emotions, and for the love of all things theta sensitive, do your own research before clicking buy. All right, let's get into it. So the market's been wild. Tech is still hot. Nvidia just hit a $4 trillion market cap, Apple's coasting sideways like it's on Ambien, and Microsoft keeps printing like it's allergic to drawdowns. Perfect storm for some smart, higher probability option setups. And no, we're not talking about weekly lotto tickets. We're talking 3 to 6+ month contracts with actual delta, real movement, and risk that doesn't make your blood pressure spike every time the market opens. First idea. Nvidia. The diagonal bull spread. Look, everyone and their grandma has already piled into Nvidia calls, but you don't need to chase moonshots. This one's for traders who want time, structure, and upside exposure without paying $10,000 for a deep ITM call. It's simple. Buy a long-dated call, maybe something in December or January, then sell a near-dated call against it, August or September. Keep strikes reasonable. Say, buy the $130 and sell the $180. You're long the trend, short the hype. If Nvidia grinds higher but doesn't blast, this makes money. You collect premium on the short leg, and you can roll it if things go your way. It's a way to play the AI beast without gambling like it's 2021. Because let's face it, Nvidia doesn't need to double overnight. You just need it to not die. Second idea. Apple, the long strangle. Yeah, Apple's boring. But here's what's not boring. When a sleepy mega cap suddenly rips or tanks after earnings. Implied volatility is low right now, and with earnings on deck in August, this is a bet on movement. You buy an out-of-the-money call and an out-of-the-money put, far enough out to give it space. Think November, maybe a $240 call and a $180 put. It's not directional. It's pure volatility. You're betting Apple wakes up. If it makes a sharp move in either direction, especially after earnings, this trade has legs. It's not flashy, but when Apple runs, it runs. And if it doesn't, at least you didn't light that premium on fire with a 2-day expiration. Third idea, Microsoft, the classic bull call spread. Steady trend, low drama, and it still moves when it wants to. This idea is for people who want tech exposure, but don't need the emotional damage of watching Tesla ruin your afternoon. The setup, buy an in-the-money call, say a January 2026 $395. Sell the $405. Keep it tight. You cap your upside, but you also reduce your cost, and you know your max risk going in. This is a defined risk trade that gives you profit if Microsoft keeps doing what it's been doing, climbing slowly and making everyone else look like they're trying too hard. You're not going to get rich off one call spread. But you also won't be explaining to your spouse why your brokerage account says $8.13. Now, why these three? Because they all hit the sweet spot. High-quality tickers, options that move, and strategies that respect risk. You've got NVDA for momentum, Apple for volatility, and Microsoft for steady trend following. And all of them involve buying time, because time is your best friend in options. Unless you go full degenerate and try to time earnings with a 0 DTE call. In that case, you're not a trader. You're a meme waiting to happen. So if you want options that actually move, don't chase the next AMC. Go with structured trades, buy yourself time, and trade with a brain, not just a dream. And again, not financial advice, just ideas. Trade smart, stay alive. And if your contract still has value by the end of the week, that's already a win in this game.